Hello everybody and welcome back to my channel, and if this is your first time here, welcome. This is Essential Patience and I am Patience. In today's video, I am going to be talking about 10 mistakes that new investors make. I've been investing for about 3 years now, so I know a little something. I'm just trying to share mistakes that I made and mistakes that I see other new investors make in their life. Remember to like this video and subscribe if you haven't already, and let's start with number one. So number one is not investing sooner. A lot of time when you start learning about investments, I started learning about the age of maybe 17, and I had already heard about it several times whilst I was in high school, but I didn't know deep dive information and everything, step-by-step guide, and I was learning more about it. But even when I did, I was kind of scared to invest because it's such a scary world out there, and I felt like I had a lot to lose. And I also had this idea about waiting till the perfect time to invest. Like, when do I get to the market? It wasn't just the fact that I was trying to time the market. So I really wasn't, but some people do try to time the market as new beginners. But when do you get in? Well, the more you wait, the more you're just waiting. You're not in the market, you're not investing, you're not learning as quickly. Put just a little in there, watch it, see what's happening. But it's a really good idea that when you're ready to start investing, just invest, and don't even wait till you're ready. Like, when is anybody ready to do anything? You just gotta do it. Not waiting to the perfect time. Just go ahead, invest, and start learning about it. Number two is investing while you're in debt. And I'm talking about excessively investing, because the truth is the market doesn't always just go up. On a 50-year average, the S&P 500 and just like index funds have averaged about 10 to 12%. If you're trying to invest a lot of money while you're still in debt, especially high interest rate debt, I really don't think that's a good idea. And the reason why is that if you're trying to make 10% on the market, which in a year, you can't guarantee that in a year, but you have a credit card that has a 21% interest rate and you have debt on it, it is just better to pay it off. Or if you have a payday loan, if you have high interest student loan debt, I'm not saying don't invest at all, but don't excessively invest. Focus on paying off those high interest debts so that then you can have more money to go towards investing, especially if it's money you plan to be using in the near future. Just in case the market is down and you need money, you're not going straight to investments to liquidate to pay off this debt that you have, and go ahead and invest when you don't have all these debts waiting around. I would say some debts that you should clear is like if you have auto loan and it's especially at high interest rates, and credit card debt, any payday loans, any student loans, you want to take care of that. If it's a mortgage, it's kind of different. You know, you may want to pay extra on your mortgage, but there's nothing wrong with keeping your 15, 30-year mortgage and investing your other money. Number three is trying to time the market. If you're trying to invest, the best way to do it is to dollar cost average. I'm sure if you've heard this before, you know what it means, but if you don't, basically just buy high, buy low, buy. You don't want to be the person who is waiting for everything to get to the bottom, because how do you know it's the bottom? You might buy the bottom and then it goes deeper down the bottom. What are you going to do? Liquidate and try and buy the bottom again? Recently, the stock market had been really down last year, 2021. This year, it's doing better. I don't know, by the time this video comes, who knows, it might have tanked again. You don't want to be the one trying to time the market, because a lot of people try and do that. Professionals have tried, hedge funds. Warren Buffett puts it best: time in the market beats timing the market. And a good way to do this is to invest consistently. So maybe you invest every week, every month, consistently over a long period of time. You might feel more of an effect of like if it crashes, if you're dumping all your money at once and then not investing again. I've done that before, and when it goes down, you feel it because all that money goes down. But if you're buying consistently and dollar cost averaging, you'll be just fine. Number four is investing in single stocks. Now, there's nothing wrong with investing in single stocks. I would not recommend anybody who doesn't have extensive knowledge and haven't done extensive research invest in single stocks. And here's why. A lot of the companies that were on top 20 years ago are not the same companies that are on top this year. Remember the dot-com bubble? It wasn't pretty. I've invested in single stocks with regret. It wasn't too bad. I'm glad I got out of my system, but currently and for the future, I don't see myself investing in single stocks. But single stocks, you put in a lot of faith into one company, and do they crash? And if they crash, and most companies at some point in their career will lose money, and we can see that a lot of companies that were huge 50 years ago don't even exist now. But if after me saying all of this, you still want to invest in single stocks, I would say do your due diligence. Do proper research. Don't just get into a stock because everybody else seems to be buying it. If you feel comfortable with it, you can proceed, but do it with money that you're not counting on so much. Even if you're doing single stocks, still diversify and have a comprehensive portfolio of different assets and different asset groups so that you're not putting all your money into one company, because that could end badly. Number 5 is turning investments into gambling. As humans, we all know, like, it's easy to turn something into an addiction, and one of those could include investing. Some people get in there, they see how quickly they're making money, and they think, oh my god, like I could do this more often. One of the ways people do is options trading. And I've heard so many stories of people losing money because they even took out loans to invest. Just invest more than they should. They're just gambling, borrowing against their house, using properties they have as collateral. Can get really bad really quickly. Just because you hit big on one stock does not mean that you're gonna hit big on every stock. It can become gambling and it become an addiction. Don't turn investing into gambling. This is money that you should be comfortable with investing and just letting it go most of the time. If you're always buying, selling, you may want to examine that and see where you are. Are you losing money investing? There were topics about this back in 2021 and 2022, including some companies getting into trouble and questioning their ethics because of making investments seem like gambling. So please be careful on this, because it's become an issue for a lot of people and it's easy to lose money if you turn investing into gambling. Moving on to number 6 is over investing in alternative assets. So I'm talking cryptocurrency, I'm talking artwork, not traditional investments. The reason I'm telling you this is because I've invested in cryptocurrency and the company is going bankrupt. But the good thing is I invested only a little bit of money that I knew that if I lost, which look at this now, don't put your life savings into alternative assets and alternative investments. Make sure that you're keeping a balanced portfolio. If you need professional help or an audit, make sure to get it, because it's worth it than getting to a point where you're losing your life savings. So do not be overly confident in alternative assets. And I would suggest that you don't put but a small percentage of your net worth into alternative assets. If it doesn't grow and if you lose it, you would still be fine. And for me, I stick mostly to traditional investing in index funds, because I think that's just the safest for me and has for many people for many years. So that's what I stick to. But if there's something that comes out and I'm like, okay, I just want to try investing in this, I'm still not gonna put my life savings in. I'm definitely less than 10% of all my money and my investments. Number 7 is panicking and selling when the market is down. A lot of new investors do this, and even investors who have been investing for many years, when they see the market is down, they sell their investments at a losing cost and then basically cash out, and then they hold on to their cash, which a lot of time cash is losing money, not now because banks are paying a higher yield interest rate to keep your money with the banks, but other times they take out their money, they keep it in cash, and mostly not even a high yield savings account, in a regular savings account, losing money, depreciating, and then they sold when it was low and they're gonna buy in high. Nobody perfectly times the market. It never happens, and if it does, it's out of pure luck and it's more likely never to happen to you again. So a lot of time we can see during the economic crash in 2008, the stocks were down, index funds were down, real estate was down, the market recovered. Did it take a while? Yes. Whatever money people lost, then if they didn't sell it, it grew. If you didn't do single stocks, I'm talking about if you invest in, like, say, the S&P 500, you recover just fine. And a lot of time, I think you're more likely to sell if it's single stocks. If it is an index fund, you're less likely to sell, in my opinion, because the S&P 500, for example, if one company is losing money and it's going down and it falls out from being one of the top 500 companies in the country, it's out. A new company is in. So there's more security in that. The S&P 500 is basically the US economy. It's not going to go to zero. And if it goes to zero, it means the entire world is ending, basically. So there's a lot of security net. Does it go down? Yes. Would it go down in a bear market by like 30-40%? Yes. It's still representing the US economy. So there's a little bit of security in that. Don't panic and sell. The best thing sometimes is to not look every day. Just look once in a while, maybe every few months if you need to, depending on how you see yourself. If you're a person who is impulsive or not, but don't impulsively sell. Number 9 is investing in ways or on platforms that are high cost and demand high management fees. An example would be if you are investing, say, your Roth IRA, which you invest now maximum $6,500 a year for your individual retirement account. Imagine if you put an account manager who is charging like 2%, it yields 10% per year. He or she is going to take 2%, and then whatever other management fees is accrued, basically you're losing money. And this also includes buying index funds or stocks that have high fees. There's no reason why a management fee should be costing more than 0.5% per year. If you're pushing it, it should be more so 0.25% per year. Having high cost and high management fees for your investments is basically means that you are losing out on money, and not just the regular money you're earning, but it's the compound interest. Go to an investment calculator, put in the same amount and everything the same, but do the difference between 10% and 8%. You would be surprised how over a 40-year period you are losing millions, and at minimum hundreds of thousands. So take that into consideration when you are trying to get a professional to manage your portfolio. How much do you really have? How much assets are they managing? And if they're not managing like millions of dollars, you may want to reconsider. And also remember that when a lot of these people are managing your portfolio, they have to feed their families no matter what. If your portfolio goes up, or let's say last year where it tanked 30% for a lot of people, guess what? They will be taking 2% if that's what is agreed upon. So they take 2% of the total that you have. It's not 2% of what was gained. It's not 2% of what you invested that year. It's 2% of total. So you want to consider that as well. Is it worth it? For some people, it is. For others, most people, it's not. And number 10 is not starting to invest at all. There's so many opportunities, especially if you're working for 1K, getting the employer match, but so many people don't start investing till much later in their life. And when you're missing out on not just if you have a 401k and a match from your employer, but also the tax benefits and the compound interest that you just can never recoup. You can't recoup compound interest. So if I invest $500 today for 40 years and then $500 10 years from now for 30 years, it is not the same. So make sure that you start investing. Even if it's a little that you have, start investing. Make sure it's not money you are going to need anytime soon. If it's money that you're going to be needing in the next 2 years, I would say definitely put it in a high yield savings account. Watch my video on high yield savings account for the Capital One 360 savings account, which is great. Do not put it in there because the market could go up and down, totally just messing up a lot of things. So don't do that. But if it's money that you're saving for retirement, invest it. If it's money that you are just trying to invest for a future house, future goals, like that is years in advance, invest it. Don't miss out on investing because you're scared. At least try it. At least try it. And invest in index funds. I think I'll be doing in the future a whole video on index funds. But make sure that you are investing and not missing out on it. But this is not financial advice. This is for entertainment purposes only. So don't try to sue me. Well, thank you for that. So for me, I really believe that a lot of time investments are for long term, and I'm going the distance with it. I hope this video was helpful. And if it was, like this video, subscribe to my channel because I bring these topics up all the time. I like to talk about finances. So if you want that and more, be sure to subscribe, stick around, ring the notification bell because I post 2 videos a week on Tuesdays and Fridays. Come over and see what we're talking about and leave in the comment section. Do you have anything else to add to this list? Is there something that you wish you had known when you started to invest? Let me know. Thank you for watching again, and I'll see you in the next one. Bye.